Every single social media trader is talking about top ticking right now. They're trying to catch the bottom and the top of every single move so that they can post about it on social media and sell courses. And I'm here to tell you that top ticking is absolutely great if your main objective is to blow your funded account as quick as possible. Like, think about it. What would be the best way to trade this move on gold right now? Would it be to try and catch sells on every single high to catch a small reversal like this? Or would it be to wait for a pullback following the trend and catch a buy here, here, and here, following the move upwards and hitting TP every single time? Now, I have so many friends who've tried top ticking, and every single one of them has told me the exact same thing. Top ticking the market is not only stressful, but it doesn't work. It results in a super low win rate, and essentially these traders that you see online catching these mega moves are showing you a 1 in 20 result of failed trades. Then they hit one, pop it on social media, and try and get people to buy their course. So in this video, I'm going to be showing you why top ticking doesn't work and how you should be trading a continuation model just like I do that's going to allow you to print on the markets every single day. So without further ado, let's get into the video. So before we start getting into my continuation model, I want to talk to you about exactly why top ticking doesn't work. Now, essentially, top ticking is trying to catch the top and the bottom of every single move in the market. Now, it's trying to essentially catch the bottom so you can ride it up and get a massive 1 to 10, 1 to 20 risk to reward trade. And that looks and sounds sexy, and it sells courses on social media because it's exactly that. It is just something to sound sexy. It's a viral trading strategy that traders are using to get your attention. But the problem is they are showing you the one time that it actually worked. They're not showing you the 10 times they got stopped out before the move that they show you. It's survivorship bias. You're only going to see the winners. And what they don't tell you is their win rate is probably like 10 to 20%. And it's actually stressful. Like, imagine coming to the charts every single day and you actually ending up losing more than you win. Why would you want to do that? Whereas I come to the charts every single day and I know statistically it's likely that I'm going to win on that day, which gives me more emphasis, more excitement when I come to the charts. And it lets me stay way more disciplined because I know for a fact that when my move does print, the likelihood is that with my high win rate, lower risk to reward model, I'm going to be winning more often than I lose. Now, traders fall for it because they want to see that high RR move. They've been conditioned to say you need to hit a 3 to 1 or a 5 to 1 or a 10 to 1. Otherwise, you can't be profitable. But in the reality of it, the math says that any RR can be profitable, even a negative risk to reward, right? Even a negative risk to reward can be profitable. Let's say I'm risking $100 and I'm making back on that trade $50. Okay, as long as my win rate is over 65%, I'm going to be profitable. And over the long run, my account is going to be positive. I'm going to pass funded accounts and make money, which is exactly what I've been doing. Now, let's see exactly why top ticking doesn't work, though, in terms of fundamentals. Well, it's very, very simple. Imagine you have a market trending bullish like this, okay? You're trending bullish like this, and essentially you want to try and catch the highs of the move. Well, how likely are you to actually catch these highs when they're being made? Very unlikely, right? And if you do end up catching something that you think is the high, and then a small higher low is put in, and the market continues up, what happens is you get stopped out very, very quickly. Now, they'll say that, oh yeah, that doesn't matter because the winners make up for it. Maybe so, but I would rather have a much more simplistic and way less stressful method of trading, where when we have a bullish market like this, all I need to do is simply wait for a pullback and try and catch a buy position on one of those pullbacks and follow the market up. And the great thing about this is, even if I catch the worst entry possible, let's say that I end up catching a buy on the higher high being made right here. Well, because I have a decent stop loss and I have some tolerance in terms of pullbacks being made, and the fact that I'm going with the higher time frame trend, the survivorship rate is way, way higher because it's so forgiving. Trading with the trend is going to allow me to actually, even if I do somehow get a bad entry, the trend is going to save me and be my friend, and inevitably either I get out at break even or I let the trade run into profit nonetheless. Now, even if a top ticker does try and follow the trend, which some of them do, let's say they try and catch the bottom of the move to take buys upwards in this market, what happens with your super tight 10-point stop loss if the low that's being made here is actually way lower than you expected, where you get stopped out, you try and take it again, you get stopped out, try and take it again, and you get stopped out again, and the process repeats until maybe you catch a runner. But what is the point of doing that when you can just lower your risk to reward, trade with the trend, and trade a continuation model like I'm about to teach you? Now, continuation trading is something that I do because it is so easy and it is also so forgiving. So if you're a newer trader or someone who's been struggling in the past, you need to understand that if you are trading a continuation, even if you get that terrible entry, you are not fighting fighting the trend, you are trading with it, which means you are going to be forgiven by the market for getting a bad entry. I like to use the analogy of if you're trying to swim against a river, against a stream with a high current, think about how hard it's going to be to swim against that river rather than swimming with it. If the current's going this way and you're trying to swim against it, all right, it's going to be extremely difficult, extremely tiring, and extremely mentally fatiguing. Whereas if you just slowly and steadily allow yourself to coast along the river with the current, that's going to be way easier, require way less effort, and it's obviously going to work way more often. For example, this move that we have on gold here, I actually caught buys here, here, and here on this move, right? And that has essentially meant that I've been able to take 4 positions on this market, whilst every single time I was taking a trade, I had at least one person telling me, bro, you're buying the top, bro, the move's already been made, you've missed the move. The good thing about trends is they like to continue, right? Trends continue until they don't. So let's think about it this way. If a trend continues more often than it doesn't, which is obviously doing because as you can see, it's a trend for a reason. If you're saying that the trend continues 9 times out of 10, okay, that means that if we're in a bullish market and I take buys, 9 times out of 10, I'm gonna be correct. Whereas if I try and trade against that and I try and take sells, only 1 in 10 times I'm going to be correct. Now, which would you rather do? Would you rather trade with the market and be correct 9 times out of 10? Or would you rather actually just try and get that 1 out of 10 and try and hit big with that gambling mentality that top ticking provides? Now, obviously your answer is going to be that you'd rather be right 9 times out of 10. It's just common sense, and that makes the most sense overall. So what is my continuation model that allows me to actually be right 9 times out of 10 and also allows me to catch those lows when they're being made in a trending market? Well, let's imagine that this is our range right here. You have support level here and resistance level here. Now, I have other videos on this entire strategy in my previous channel videos. So if you want to check them out, go and take a look. But let's imagine that price starts to do something like this, right? We're obviously in an uptrend. It starts to do something like this, and we continue from one range to the other. This is great. But the thing is, once this candle breaks out, what's it going to do? It's going to go to the next range. So as you can see here, we have 2 clear entry models that we can take in order to actually catch a continuation of a trend. Now, the first one is going to be the breakout after, a trending market initially breaks out the range. Now, let's just remove this to make it more simple. You break into a new range in a bullish market. What are you going to do most of the time? And this is one of the most simple concepts in trading. It is called a break and a retest, right? Now you break into a level, you retest that zone. We take the buys, continuing up towards the next level. And that is extremely simple. Now, obviously there's a few more nuances that I'm going to go into in a second. But the other way that we can actually take a position like this is, let's say we've made our push up in a trending market. We start to consolidate, and then actually we break below the range a little bit and continue with the trend. Now, this is what some people call AMD. I like to just call it consolidation followed by a liquidity grab and then continuation, right? So once we have that understood, we can actually decide, all right, I'm going to wait for this market to start ranging, consolidating, and we take a position after we close back into the range, which is my fake out model, having faked out below the range here, where most people will be thinking, okay, we have a reversal here. Let me try and catch the reversal and take the sales downwards. We wait for a fake out, which is a fake breakout below the range, followed by confirmation of a closure back inside the range, and we take the buys to continue up either to the top of the range or even the top of the next one. So we have one model here, which is obviously the breakout, and the next model here is going to be my fake out model, and we're going to say it's using a liquidity grab after consolidation. So it's a consolidation model to trade during periods of ranging, because I know a lot of people don't want to do it, but you can actually make serious money. Now, let me show you an example of both of these on the chart, starting with the breakout. Now, the very simple way I trade a breakout is exactly like I said. I'm going to mark up my support and resistance levels very clearly. All right, something like this. You wait for a closure above those levels. So you're going to see a resistance level right here. In a bullish market, obviously, we're going to be waiting for a closure above a resistance, which is right here. I'm going to mark this with buys above right here. The moment this candle closes above the level, which it did here, you can see, just as I showed you on the diagram, it breaks above the level. In this case, it actually comes down and retests a little bit below, and then you take the continuation up and it follows the trend like that. And we would actually jump in buys right here as it does that. Now I'll show you exactly how that works in a second. And essentially it's going to look something like this. The way I like to take it is extremely simple. We have our range like this as shown. We break out above the range with the first candle, which is essentially going to be the breakout candle. So once this candle actually closes above on one of the higher time frames, like the 30-minute or the 1 hour, as long as we are with the trend, there is an 85% chance that this candle right here, after breaking out, is going to fill up in the next candles towards the top of that next range. So all we have to do is essentially wait for that to happen and actually jump on the move, right? So all I'm gonna do after this initial setup candle here, which is the breakout candle, I'm gonna wait for the next candle to come down with a bottom wick first, i.e. the retest or the liquidity grab, as it did on the previous example I showed you on the chart. Once this candle can actually come down here and actually grab enough liquidity based off of previous areas of rejection. So we'd look to the left of the charts and we'd see previous areas like this. Let's say our target for liquidity grab for a bottom wick was 82.6 as an example. All I would need to do very simply is either jump in an immediate off the rip buy entry as it does that, if it's got no top wick, or as this candle comes up and flips, what I can do is I can just purely place a buy stop on the flip of the candle right here. So my order would be a buy stop on the flip of this candle. My stops would be below the previous candle. My TP would be the top of the next range. And once this candle goes ahead and actually flips from a bearish candle to a bullish candle like this, all I would do is get activated into that buy position, and I'd just be targeting very simply the next resistance area. Now this is extremely simple, and you might be thinking that exactly, well, this is way too simple. This can't be a model. You need an inverse FVG, you need a liquidity sweep, SMT divergence, all of that shit. No, you don't. It's so simple to be a profitable trader as long as you follow the trend, right? Because essentially, the market becomes so forgiving. Now, with the example that I showed you here, we have the exact same things being printed, like I just showed you, right? We had the clear closure above the level here on this previous candle. The next candle comes down, forms a bottom wick. Now, you could either look to the left on the charts and say, all right, cool. Where does it grab bottom wicks for previously before it pushes up? Well, actually, in this case, it's a lot lower down. It actually grabs wicks from like around this area here. So that wouldn't have been enough for me to take that off the rip entry. But what I can do is I can place a buy stop on the flip of this candle after it makes that bottom wick and grabs liquidity. And we know now there's a likelihood that this fills up to the next range. So our stops go below the previous candle. All we need to do is look at where the next resistance area is, which is around here. And essentially, we're just taking this trade up towards that level here. And as you can see, TP would have been hit with relatively low drawdown. Now, obviously that doesn't happen every time, but you can see quite clearly how I'm taking advantage on the higher time frames of this trending market structure. And if I drop down to the lower time frames, you are going to see that all I've actually done is caught the lower high being made as we continue up like this. You caught the higher low being made, and as you can see, it never comes back down to the entry. And it's so simple using higher time frames to identify the market structure and identify your entry. You don't even need many other confluences other than a trending market, liquidity being grabbed in the form of that bottom wick, and the volume. That is literally it. And you can see here as well how exactly the same thing happened over here on the 1 hour. Again, look, you have a closure above the range, a retest, and then a continuation up. Now, this one didn't print my entry model, the first one, but it actually did print the fake out model, which I'm going to show you in just 1 second. But before I show you that, let me show you how accurate these levels are. Look at this. I've drawn my support and resistance levels here to the left, and I drew these on stream throughout the week, so you can go and check that. I'm not just drawing this in hindsight. All right, this was our level as a target from the entire beginning of this week. And you can see what happens after we do close above this candle right here. We end up closing and filling up all the way to the top of this range before making a very strong rejection to the downside. So that as a TP becomes so accurate. But you'll notice how I just said, yeah, the breakout model didn't form, but the fake out model did. And this is exactly why we have a couple of models. Now, obviously I trade a lot more, but just showing you these two in this video. Let's imagine we have another range here and you have something like this being formed. Now you have a closure above like this. Maybe what happens is you don't get the breakout and it starts to fill the range a little bit, but then the market begins to consolidate. Cool. You start to consolidate within this range like this, and essentially what happens is you've got no entry for the meantime. But as we all know, markets consolidate before they make an initial further push. So you've got your consolidation here. Maybe you start to actually just barcode for a little bit longer. And then what happens is you see a sharp stab below the range. You see something like this. You get a candle closure below the range like this, which a lot of people would be thinking, oh, okay, you've consolidated. Now you're making bearish structure. You flip below and they jump in the sells, right? And that's exactly what the market is doing. It's waiting for a breakout trader who's not as advanced as me to think, oh, we've broken out. Let me take the sells. And what ends up happening is you go ahead and you get wrecked, right? But this is actually just liquidity generation. We have liquidity in resting orders below these lows, below our resistance levels, below previous candle lows. The market is coming down, grabbing into these orders and essentially grabbing liquidity. Now, if you want to learn liquidity in depth, there's another video on my channel on that. But for right now, all you need to know that these are resting orders that are being filled, grabbing liquidity for the extended move upwards. And what happens next is very simply, you start to actually close back within the range like this. And once we close back within the range, for me, that is an extremely high probability trade that we are going to then end up filling the range to the upside. So all I need to do when I see this is I need to see the next candle after a bullish closure, again, come down, maybe form a retest or just a small bottom wick, flip bullish, and then I'm going to be in that trade almost immediately, taking it up towards the highs. And the good thing about this model as well is you don't even need to take this towards just these highs right here, right? You can actually take them even further towards wherever the next level is, because if we look at market structure, what you have is a very simple higher high being made, higher low. And what do we know about the trend? If this trend is going to continue, it's going to actually break this previous high here, right? It's going to break above that, maybe retest it, and then continue up to the next level. So we can actually take a extended TP on this, which ends up in a positive RR entry model, which is just extremely effective because it has a high win rate and also a high risk to reward, which most people say you can't have, but I promise you can. And if I show you an example of this on the chart, it happens in a number of ways. First of all, I can show you what happened just now. So this one didn't consolidate as much. I mean, it did consolidate a little bit, but it was more of just an immediate fake out followed by a continuation, right? You have the closure above, fake out below the range. A lot of people are thinking, oh, look, you have two bearish closures, a doji closure, and then a top wick. Maybe this next candle is going to flip down and fill the range. They get trapped in sells. It takes out the high. And once those traders actually get taken out with their stop loss, this provides even more liquidity to the market to then continue up even further. Now, that would be our entry right there based off of actually this bullish candle closure here. After it closes respecting, you can see the next one made a small bottom wick because that's all we need. And we take an entry, stops below structure, most likely TP towards that previous resistance level that I showed you. Alternatively, this can happen when the market begins to consolidate. So as you can see right here, gold made a small down movement here, whilst obviously maintaining its bullish structure on the higher time frames. This is on the 30-minute right now. And you can see we start to make a consolidation between these two levels right here. In fact, we made a consolidation before and we just began to do it again, right? You could even say that your level was down here at like 71.3. But as you can see, you begin to consolidate. If you drop to the lower time frame, you're going to see it again here as well. You start to consolidate. And then what ends up happening very clearly and very simply is you actually end up closing below the level like this. You close below the level, everybody thinks, all right, we've finally broken out the consolidation, we've finally broken out, and yeah, it ends up grabbing liquidity, especially bonus points if it ends up like grabbing a previous wick low like this and breaking below them, because there's lots of orders that rest down here below these lows around there. And what happens is it grabs those orders, everyone jumps in, sells, trying to catch the move down, anticipating that we're going to have a reversal to the downside. And what happens is they end up getting stopped out above here and you see the move continues. Now what I did is essentially end up catching the closure after a bullish close within this fake out right here. You can see you fake below the level, so a fake breakout, closure back above, and then we take the buys very simply up towards the top of the range. Now, aside from the technical side of trading, from a psychological aspect, continuation trading just makes so much more sense. Now, think about it from a logical perspective. Imagine you were coming to the charts every single day, trading with a reversal model with a super low win rate, and you know for a fact there's more of a chance that you lose today than actually winning. Why would you ever feel like trading that way? Why would you ever be excited to get up in the morning to trade and get to the charts? You wouldn't, right? Because you know for a fact the likelihood is that you end up losing. As well as that, it brings in the gambling mindset of, oh, I've lost 8 of my last trades. I need a win right now to make myself break even, or to make myself, you know, even a slight bit in profit. Whereas with me, I get to the charts with an 85% win rate every single day. I know for a fact there's a high likelihood that my trade wins. If I take a loss, it mitigates maybe the past couple of days wins, maybe not even that. And essentially trading with a 1-to-1 risk to reward, or even a slight bit less than that with a high win rate, means that I get to the charts every day. I'm super disciplined because I know that if I take a trade, or if a trade forms, then I'm going to be rewarded for it. And I also know that when I come to the charts, the higher likelihood is that I actually end up and leave the charts richer than when I got there. So why the hell would you not want to trade in that way? As well as that, you just have a much higher confidence in your trades because you know for a fact that even if you did end up getting a slightly worse entry, the trend is going to make up for that. The direction of the market in an overall standing is going to be something that is on your side rather than working against you. Now, how much more easy would it be to actually be trading with the market and understanding that despite what happened, the only thing you really need to worry about is whether you've got your stop loss in the right position. And you know for a fact that if your stops are in the right position, you're either going to survive the trade and it's going to run to your take profit, or maybe you get stopped out once in a while and that is actually the 1 in 10 time when the trade starts to reverse. But it's not all sunshine and rainbows, right? I want to talk to you about some of the mistakes people do make when actually continuation trading. Now, one of the main things people struggle with is they end up entering on the high as it's being made, right? So as you see a breakout being made, you end up entering on the high, you don't wait for the liquidity. And then what can happen is, and it's so frustrating if it happens, you get stopped out and then the move continues in your favor. And that's what leads to FOMO and stuff like that. And the way to combat this is very simply using exactly what I taught you. You wait for the breakout first, then you wait for the liquidity grab or the retest, and then you take the position. So it would look like this. You'd be looking to take the position either here as we close bullish again, or here if you're super aggressive, or even here as we break out the third time. But you know in that point the market is with your favor and you actually have a lot higher chance of succeeding and being profitable rather than actually trying to take an entry as that high is initially being made. As well as that, people fail to identify the trends. Now, one of the main things that's good about continuation actually is that you can trade on lower time frames with the higher time frame trend. So as we can see right here, until recently the 4-hour and the higher time frame trend has been bullish on gold. And in fact, I would say it still is, to be honest. But let's say that the higher time frame is bullish. What you can do is you can jump down to the lower time frame, so even like the 5 and the 15 minute, which I don't recommend for newer traders, but you can do it. And even then you can spot the highs being made and the higher lows, and you can jump in positions, and that higher time frame trend is going to take advantage. Now, I've made a video on multi-time frame trading on my channel and how I use every single time frame as a confluence in another video, so make sure you go and check that out. But realistically, if you trade continuations just like that, it is going to be so much easier for you to go ahead and actually take profit from the market. But the one thing people struggle to do is they actually will look at the lower time frame trend right now. They'll say, okay, the 5-minute time frame is bearish. I'm going to look at taking sells, which, yeah, maybe it'll print out every now and again. But if we actually drop to the 2-hour time frame, let's say, or the 1-hour time frame, even the 4-hour, look at it. You can see that we're actually very clearly bullish in terms of recent price action, which means I don't want to even be taking sells. And if a sell setup does print, I'm just not going to be taking it because I'd rather follow that higher time frame structure. This 4-hour time frame could just be a liquidity grab. The candle could flip and it could end up doing something like this. And you jump in sells, you get caught out because you're not looking at the higher time frames. And yeah, that's one problem that people have. But if you do learn something from this video, it's got to be this. I want you to build an action plan of exactly what you want to do in terms of your trading. Stop trying to top tick, just seriously stop it. Every time you think this looks at the top, just resist, right? You're gambling, you're not trading. Delete TikTok or stop looking at TikTok videos glorifying catching a 1 to 30 risk to reward. It's not sustainable in terms of trading. Real traders know you only need a model that actually prints consistently and that is profitable. It doesn't need to be 1 to 10. It can be a 1 to 1, even a 1 to 0.5. I actually became profitable with a 1 to 0.5 RR model. So I know you can make money doing it. I've made hundreds of thousands of dollars doing it. Stop getting this brain rot strategy in your head because it just does not work. Step number 2 is learn to identify trends. So I want you to go ahead and actually just on the charts, plot out trends, see what you think is printing, and check if you're right over time, right? It's very important. It's a very simple thing, and a lot of people will be like, I know how to identify trends. Well, if you did, you'd be catching the continuation move every single time. So go back, review it on every single time frame. Study the pullbacks is step 3. Go back through trending charts, look at what happens with the pullbacks, and look at actually what happens where the market rejects from. Look at previous wick rejection areas like this. You can see very clearly you reject from similar areas over time. We had a rejection here, and then surprise, surprise, you get another rejection here again as well. Price prints overall on the market over and over. History repeats itself. And yeah, next step, journal everything. I want you to go ahead and actually practice the systems that I've taught you within this video and journal it all. And actually figure out whether you're actually catching the bottom of the move or catching the pullback that you're trying to catch. Or if you are top ticking, journal it and figure out that you're actually blowing accounts and losing money doing it, right? Now, the uncomfortable truth is that top ticking does look cool on social media, but your account balance does not care, all right? It doesn't care about looking cool. My account balance doesn't say 1-to-1 risk to reward at the end. It doesn't say 1-to-10 risk to reward. It doesn't say, oh my God, you got 50,000 views for top ticking this. My account balance says withdrawal processed, all right? And that's the only thing that fucking matters, all right? I'm making money over time using a system that is repeatedly profitable, and that is what you need to do too. And the thing is, I tried to be the same guy as you, right? I tried to top tick, I tried to reversal trade when I was very, very new, and I very quickly realized, why am I doing this? It doesn't make sense. I was constantly struggling. I felt like I was fighting against the market every day. And then I learned continuation trading, and it felt like, oh my God, the market's trading with me. The market's suddenly on my side. And I ended up building $1 million in funded capital in less than a year and making 20K months pretty easily in the market, right? So you can either keep trying to predict reversals, or you can go ahead and actually try and trade profitably with probability on your side, trading with the market. One of them is going to blow accounts and one of them is going to build it. It's very, very simple. But the bottom line for you guys is I want you to stop top ticking. It's a low probability, high stress way, and it's going to drain your accounts, right? Like, start continuation trading, wait for the trends, wait for pauses, and enter when we start to get that and enter when the trend is continuing, right? Try and catch that pullback, or even just try and catch the continuation. It's gonna work way, way higher. Now, this is how I got to 87% win rate. This is how I built $1 million in funded capital. This is what I teach in TRLS. Now, if you want to learn how to identify these setups exactly like I do, or if you want someone to check your entries and trade with you, keep you accountable whilst you're becoming profitable, then the link to my mentorship is down below. I'll teach you exactly this, as well as all of the other systems that I trade with, how I became $1 million in funding, how I pass funded accounts and get payouts almost every time. Now, I only work with a few students at a time, so if you want to join, the link to the wait list is going to be down below because slots are currently full. So yeah, click that link, learn to become a profitable trader, and I promise you, whether or not you join, stop chasing top and bottoms, right? It's just not going to work. Start trading with the trend. The market rewards your patience and your profitability and not your prediction, right? Now, subscribe for more real trading breakdowns, and I'll see you guys in the next one.